All right, ladies and gentlemen, it is now 8:30. We will be getting started. Welcome to TaxCraft. TaxCraft is Ichiban's quarterly tax call, where we look at the developments in the tax world from the past quarter and also take a look at what we might be looking forward to in the coming days. My name is Carol Kariuki. I am the CEO at Ichiban Tax and Business Advisory. Our presenters today shall be Robert Wariro, our partner, as well as Christine Deritu, our regulatory and tax advisor. As we go through, we'd like to ask you to put your questions into the chat so that as we come to the close of our presentation, we can handle your questions. I will also be sharing a survey a little bit later in the call for us to get to hear your thoughts around the tax dynamics of the country. So I'd like to hand over to Robert to take us through the presentation. Karibu sana.
Thank you. Thank you very much, Carol, and good morning, ladies and gentlemen. Indeed, it's been a busy quarter, especially from a tax perspective. We have not seen such a busy first quarter of the year. And so without further ado, we'll just go straight into the discussion, and that will be the developments of the first quarter. What is the outlook for 2025? What should we be expecting? And then, as always, we look at recent case law and what that means for you and I in terms of business. And at the end of it, we shall have a session for question and answer session. Now, in terms of the developments, just at a high level overview, we'll be looking at the changes in NSSF. Those have come through in the quarter, as well as the remarkably higher amendments that we have seen in the quarter. It's very uncharacteristic to see amendment bills from a tax perspective coming in the first quarter. And so this is an interesting one. And then lastly, we look at other tax developments. Diving straight into the NSSF, you'll recall that we had the NSSF Act 2013 that had been declared unconstitutional by the High Court. Then the government appealed to the Court of Appeal, and sometime in September 2022, the Court of Appeal ruled that it is now constitutional. And following that, starting February 2023, NSSF started implementing. So we had the first phase in 23, second phase in 24, and now we have the third phase coming in 2025. And the key change here is the movement in the lower limits from 7,000 to 8,000 shillings, and then the upper limit from 36,000 shillings to 72,000 shillings, effectively doubling. What this means in a nutshell is that your contribution, if you're earning 72,000 shillings or more in a month, your contribution moves from 2,160 to 4,320. It effectively doubles. And so that's what you probably have seen in your payslip for those of you who are above that. Then at a global level, we have seen NSSF reporting some very, very impressive numbers in terms of investments. And this was expected given the almost tripling or quadrupling of the contributions on a monthly basis. Previously, people used to pay 200 shillings. So this going to 4,000 shillings is moving almost 8 times, and that is expected. In terms of the amendment bills, we have seen two critical amendment bills. That is the Bill 2025, which was published on 6th of March, and the VAT Amendment Bill 2025, which was published on 13th of March 2025. Let's start with the excise duty bill. If you look at the Tax Laws Amendment Act 2024, which came into force on 27th of December 2024, we had an inclusion of 25% excise duty on fully assembled transformers. Now, the idea here was we have local capacity to assemble these transformers. However, it has turned out that we actually do not have adequate capacity, and especially for transformers that are rated 1,000 kilovolts and above. So we don't have that capacity. And so there's now a proposal to reverse that 25% excise duty that was imposed in December on these fully assembled transformers that are imported. And so we expect that this will likely go through. And once it goes through, then hopefully even last mile electricity will be cheaper for people. Then the next amendment is around the VAT. It's actually the VAT Amendment Bill 2025. And again, paragraph 146 of the first schedule to the VAT Act had been amended in December 2024, so that if you import or if you invest in goods, capital goods worth 2 billion shillings or more, then the those goods are VAT exempted. And the idea there was to stimulate production and investment. However, the way the wording of that provision was captured was not very clear, because it said it's effective 12 months from the commencement date of this act. Now, it's not very clear whether it was the VAT Act commencement or the amendment commencement. So we have a scenario where now the bill seeks to clarify that and say 12 months from December 2024. And so to me, that is a good amendment, because it then reduces the conflicts and disputes that we're likely to see. However, having said that, this is a big issue, because remember, we had these amendments in 2024, December, and now barely 3 months after, we have proposed amendments to amend the 2024 amendments. And so from a tax stability perspective, one has to ask the question, do we really have a stable fiscal environment, especially from a tax perspective, because of these numerous changes? That's something that we need to think about as taxpayers. Other tax developments, in February 2025, the cabinet approved the Kenya-Singapore double tax avoidance agreement. And this is an interesting one, because if you recall, in 2018, Kenya had actually signed another double tax avoidance agreement with Singapore. However, the June 2018 DTA was quite controversial, in the sense that, for example, the dividend withholding tax rate was 5%. When a Kenyan company pays a Singapore entity with dividends, the withholding tax was going to be 5%. Now, compare that with the headline rate of 15%. You can see why there was a bit of noise around that. And now, the one that has been approved by Cabinet in February has a DTA, a dividend tax rate of 8%. So you can see there's been some changes, and we're waiting now for Parliament to then go through the process of public participation and ratifying that treaty under the Treaty Ratification Act. And once that is done, then the countries will exchange their instruments of ratification, and we expect the DTA to come into force sometime in January 2026. So that's an important one. Another one is the KRA has revised its internal structure from a domestic revenue perspective. And essentially what's happening is that previously we had two departments. We had domestic revenue, and then we had the Customs and Border Control. So Customs and Border Control remains intact. Domestic revenue has now been split. We have one unit now, which is covering large taxpayers' office, medium taxpayers, and public sector development, basically ministries and departments and parastatals. So that is all under Commissioner Rispa Simiyu. Then we have what they're calling the new small and micro taxpayers office, and that is under Commissioner George Obel. An interesting one around this reorganization was, immediately it was published, the court issued an injunction, and barely a day after, that injunction was lifted. So it was a very interesting one, and we have seen that small and micro taxpayers office coming out quite forcefully, and you can see that article there by the commissioner, and his focus being tax-based expansion. Basically, we are going to leverage technology, and we'll be speaking to that in a minute. We are going to look at reducing the loopholes, and we're also going to look at ushuru mashinani. What basically they are saying is, we are going to have a KRA office in Gikomba, for example, where we can interact with the traders regularly. So that is something definitely to watch. Other developments are fringe benefit tax for those of you who have loans which are at a lower interest rate. So the rate published by the commissioner for the quarter was 13%. We're now waiting for the quarter two rate to be published, as well as the low interest benefit rate coming in at 14% for the first quarter. We've also seen portability of eTIMs, and this is essentially allowing you to use either the device that has been mapped to you or any other device or system, for example, eCitizen, to raise your eTIMs invoices. And the idea there is that there should be a lot of flexibility in terms of the platform that you want to use to issue your eTIMs. And that's probably going to be a good thing for taxpayers. Again, Cabinet in its February meeting approved the increase in terms of the duty-free thresholds from 50,000 shillings to 250,000. And I guess that's a good thing for Kenyans as they're coming back into the country. So we're just waiting for that to be implemented. Lastly, from a regulatory perspective, again, you remember the Business Laws Amendment Act 2024 that was signed in December 2023. And the idea there is that there should be a lot of flexibility in terms of the platform that you want to use to issue your eTIMs. And that's probably going to be a good thing for taxpayers. around 11th of December 2024, we had the central bank increasing the capital requirements for the banks, and essentially the banks are required to ramp up their capital to about 10 billion shillings by 2029. And so CBK is saying, guys, we need you to give us your plan for raising this capital. And it'll be interesting to see how this how the banks react to this. Likely to see some consolidations or acquisitions as some of the smaller banks try to raise that capital. So those are the tax developments. Now, what about budget from a budget policy perspective? As you're aware, under the Public Finance Management Act, the government is required to publish the budget policy statement. And again, in the February cabinet meeting, cabinet did approve the budget policy statement, which shows budget of 4.2 trillion shillings, slightly higher than we have had in the previous years. And the key thing around this budget policy statement is, especially if you look at it from a comparative perspective with the 2024 statement, the budget policy statement 2024 was very heavy in terms of tax proposals. We want to increase VAT on insurance, we want to increase VAT on education, and so on. And that probably gave a lot of people time to digest these proposals. However, the budget policy statement 2025 probably, in terms of the disputes that we had with especially the Gen Z, is very thin. The budget policy statement 2025 is very thin in terms of tax proposals. So broadly, they are talking about, we have a tax policy and administrative measure angle where we're going to leverage technology to grow our tax revenues. We're going to reduce the exemptions that we have seen on some of these things, and basically that's speaking to VAT. We're also going to seal revenue loopholes. So very broad proposals, but no substantive proposals to talk about. Again, the budget policy statement is saying we are going to implement the national tax policy, tax stability. Remember, we talked about the amendments that happened barely 3 months after the last amendments by Parliament. So when you talk about tax stability, you have to ask yourself, are we actually implementing the national tax policy? Again, government is focusing on implementing the medium-term revenue strategy to 2026-2027. And the idea there is, let's promote domestic production and investment so that we can spur tax-based expansion and drive a lot more taxes. Again, something to watch out for. A very interesting one in this budget policy statement is that ministries, departments, and agencies, MDAs, have been tasked to increase the non-tax revenues. What this means and what we expect is that we will see more levies coming through. You know, for example, we had the affordable housing levy, the shisha. So when you see this kind of a proposal in the budget policy statement, I think it is a sign that we are likely to see higher levies coming in as governments try to augment their revenues. So that will be interesting, and especially when you consider that Kenya and IMF did terminate their current program, which means that we have some funding gaps. And it will take time for this the successor program to be approved by both parties. So we're likely to see the MDAs trying to plug that deficit there. And speaking of deficit and revenue projections, the budget policy statement is targeting 2.8 trillion shillings in terms of tax revenues. Again, a growth from the past years, we shall see shortly, but that also tells you that there's going to be a lot more pressure from the Revenue Authority as they try to collect these taxes. And speaking of collection, what is the revenue performance to February? At least these are the numbers that we have up to February. We're waiting for the March numbers to be published, which should be anytime soon. The first thing to note is that the National Treasury did reduce the projection from 2.6 trillion to 2.58 trillion, a marginal decrease there. And I think this is in recognition of the fact that we have been overzealous or overambitious in terms of projecting our revenues. But having reduced those projections to 2.5 trillion, as at February, KRA was at 1.4 trillion shillings in terms of collection. What that tells you is that there's a gap of about 1.1 trillion shillings to be collected in 4 months. That is roughly 300 billion shillings a month. Quite a steep challenge, and especially when you consider that the performance to December had significant challenges, especially from a VAT perspective. As you can see there, VAT had the highest shortfall of 36.5 billion shillings, whereas the other taxes like income tax at 28, excess duty had about 13, and import duty about 6.1 billion shillings. So you can see as of December, the KRA was about 90 billion short of its target to half year, and it then presents a significant challenge. But having said that, VAT in January 2025 collected 34.5 billion shillings, highest, one of the highest ever recorded. In fact, that's actually, they say it's a historic collection. So likely attributed to e-teams, and we are waiting to see whether that is going to be sustained. And we know we have a bit of challenges even from an e-teams perspective and VAT return filing. So that's something that we are continuing to watch. Further afield, in terms of global developments, the key one that we are focusing here is South Africa. You know, in South Africa, the budget was slated for 19th of February 2025. However, the coalition, you know, they also have a government of national unity there. So the coalition, the ruling coalition, could not agree on the taxes, the tax increases. In fact, one of the key sticking one was they wanted to increase VAT from 15% to 17%, but the other coalition partners could not agree to that. They did not agree to that. And so for the first time in 30 years, we had that budget being postponed, which was quite interesting. And eventually, when it was read on 12th of March 2025, the compromise VAT rate was 15.5%. Again, that gives you an idea of the pressures that the revenue authorities across the world are facing in terms of pushback when you try to increase taxes. Likely scenario to be playing out in future in other countries as well. Further afield, first of all, starting with the global reporting requirements for people who are in the financial services sector, the common reporting standards, that CRS, that reporting deadline date is 31st of May 2025. So it's important that any of you who qualifies to meet that deadline date. Now, Liberation Day, Wednesday, this week has been a very interesting time from a global perspective. And why? Because we have seen huge increases in terms of tariffs by the US, even Kenya being hit with 10% in terms of its exports into the US. But even as that is happening, the US has withdrawn from the OECD Pillar 2 deal. And the Pillar 2 deal here talks about the global minimum top-up tax of 15%, what they're calling the global effective tax rate for companies which have a turnover of 750 million euros or more in a year. So ideally, this is a global solution that says we need people to pay at least 15% corporate income tax. Now the US has withdrawn from that. And as it's withdrawing from that, it has brought in these tariffs. And as if that is not enough, as a result of bringing these tariffs, we are seeing the US responding and saying, Keir Starmer from the UK, the UK Prime Minister is saying, we need to reduce the taxes that we are charging the big tech companies, you know, the Googles, the Amazon, and so on. And so we can see the UK responding to the US threat of reciprocal taxes by saying we are looking to reduce, not eliminate, but we are looking to reduce. And as that is happening, Brazil has brought in a social media detox tax. It's a tongue twister. So they are saying for people who are spending too much time on social media, we're going to subject these big tech companies to 1% tax on their revenues. So you can see a very mixed or varied response by various countries to the US dynamics in terms of trade. And so we are waiting, we're continuing to watch this as we expect this to have significant impacts. You probably have seen the responses by the Ministry of Industrialization, from Kenya National Chamber of Commerce, everybody saying, guys, we need to rethink our situation as Kenya. So that's definitely something to continue watching in the quarter as we go along. So ladies and gentlemen, those are the recent developments. And I'd like now to invite my colleague, Christine, to take us through recent case law. Christine?
Thank you. Thank you so much, Robert. It has been quite an interesting quarter as well. We have seen a lot of changes from the case law department, where we are seeing a lot more cases being dealt with at the Tax Appeals Tribunal, at the High Court, at the Court of Appeal. And interestingly, in this TaxCraft call, we are also going to be talking about cases in Uganda that are going to be able to inform our cases here in Kenya. So to begin us off, we can start with the case of Safaricom PLC versus the Commission of Domestic Taxes. The question here was on the issue of PAYE and exactly who is subject to PAYE and should the PAYE then be paid in Kenya. On the issue of PAYE, Safaricom PLC Kenya had actually seconded its employees to Safaricom Ethiopia, and on that basis, it was paying its employees' salaries and was supposed to pay PAYE. But KRA was asking for the PAYE to be paid in Kenya, and Safaricom Ethiopia was saying that the PAYE is supposed to be payable to its Ethiopia entity because the entity is operating in Ethiopia. The question was whether or not it was actually proper for KRA to subject Safaricom PLC to PAYE and for the entity to actually pay PAYE in Kenya. The Tax Appeals Tribunal ruled that, for one, there is no provision in the PAYE in Ethiopia for employees actually acting in Ethiopia to be subjected to PAYE in Kenya. And two, it also relied on the OECD rules that provide that income generated in Ethiopia by Ethiopian employees should be payable in Ethiopia. Again, in the issue of PAYE, we talk about the Parliamentary Service Commission case versus the Commission of Domestic Taxes. On this one, it was whether or not parliamentarians, as they are, qualify as employees. And two, whether or not the motor vehicle reimbursement benefit that they get is a benefit or it is just a mere reimbursement. On the issue of whether they are employees, the Tax Appeals Tribunal ruled that by virtue of them being employed by the Parliamentary Service Commission and their contracts existing between them and the Parliamentary Service Commission, then they are employees of the Parliamentary Service Commission. On the issue of motor vehicle reimbursement benefit, it was stated that for it to be a reimbursement, there must be an issue of a payback by the MPs. But it is clear that the MPs benefit from these motor vehicles even after they are done with their terms, and it becomes a benefit to them because they're able to dispose the motor vehicle and keep the gains from that motor vehicle. On that basis, the motor vehicle reimbursement benefit was actually subjected to PAYE as well under Section 5(2) of the Income Tax Act. The third case we talk about, in this one, we're talking about the appeal procedures. And this was an appeal before the Tax Appeals Tribunal by Dr. Sibet Sargon versus the Commission of Domestic Taxes. Dr. Kibet was an employee of the World Health Organization, and he had purchased properties within Kenya based on that income. KRA assessed him and asked him to provide documentation and the actual bank statements that can show that the income that he's getting from the World Health Organization is what he's using to purchase the properties. But because the taxpayer in this case, Dr. Kibet, failed to provide the documentation, KRA assessed him and asked for the payment on the income that he had in his bank accounts. Interestingly, the appeal was not determined on that basis, and it was actually thrown out because it was filed out of time without leave of the Tax Appeals Tribunal. In an interesting case, we also see the case of Dr. David Obonyo Mreri versus the Commissioner of Domestic Taxes. This was a High Court case. Why it is interesting is because picture yourself as a taxpayer and you file your first objection. When you file your first objection with the commissioner invalidates it within 14 days and tells you that you did not file a proper objection because you did not provide the supporting documentation. Then you go ahead and file a second objection. For this second objection, KRA did not actually respond. And it only came back beyond the 60 days period to state that the first objection that was filed by the taxpayer had been invalidated. And on that basis, it was throwing out the taxpayer's objection. At the Tax Appeals Tribunal, the objection decision of the commissioner stood, but at the High Court, which is where the taxpayer appealed this matter, the High Court stated that if indeed it was an issue of invalidating the objection, then the commissioner should have come back to the taxpayer within 14 days of the taxpayer filing the second objection. On that basis, the High Court invalidated the objection decision issued by the commissioner because it was filed out of time. Again, we also get to see the case of the Commission of Domestic Taxes versus Dara Limited. In this case, we talk about whether or not deferred interest payments are subject to withholding tax. This is an income tax issue, and therefore Section 2 of the Income Tax Act, as well as Section 35 of the same Act, were being used. And what exactly is meant by deemed interest? The question was whether or not deferred interest payments actually meant that the loans were interest-free. At the Tax Appeals Tribunal, the tribunal held that indeed these deferred interest payments did not make the loan interest-free, and therefore should not have been subjected to deemed interest as KRA was proposing. The commissioner appealed the decision and went to the High Court. As the High Court again, the High Court stated that at the point of accrual of interest in the taxpayer's book is when the withholding tax should apply. But the taxpayer had actually not accrued this interest because it was actually just deferring the interest payments to a later period and therefore could not be deemed to have accrued, and neither was it an interest-free loan because the interest was still payable. It was just that it was going to be paid at a later date. We then talk about the issue of VAT. In this case, we're talking about the Kenya Revenue Authority versus David Mwangi Ndegwa. This was a Court of Appeal decision in regards to whether or not VAT is payable on commercial buildings. At the High Court had stated that when land is sold, it includes the land and the building. This is the definition that is given in the Constitution. But the question was whether or not the High Court was right to rely on the definition of land in the Constitution as opposed to rely on the actual construing of the legislative provision, which is the VAT Act, in regards to whether or not commercial buildings are exempted from VAT. On that aspect, the Court of Appeal stated that in terms of the VAT Act, it is an exemption act, and therefore anything that is not exempted is subject to VAT. Commercial buildings are specifically not exempted under paragraph 8, part 2 of the VAT Act, and therefore it could not be possible that the High Court should rely on the definition of the Constitution, where the clear legislative provision in the VAT Act provides for taxation of the commercial buildings. Then we move to Uganda. The question here was withholding tax on the throughput fees paid by Vivo Energy Uganda Limited to Vivo Energy Kenya. Throughput fees in this aspect related to the fees that Vivo Energy Uganda pays to Vivo Energy Kenya for the use of its pipeline. Remember, Uganda is a landlocked country, so therefore when oil is arriving at the port, it has to be moved from the port into Kenya, through Kenya, then to Uganda. And for that use of the port that Vivo Energy Uganda pays on behalf of Vivo Energy Kenya pays on behalf of Vivo Energy Uganda, then they reimburse the payment and pay a throughput fees. On that aspect, the Uganda Revenue Authority assessed Vivo Energy Uganda for withholding tax based on the fact that this is as income that is sourced within Uganda and should actually be subjected to tax in Uganda. On that aspect, the Ugandan Tax Appeals Tribunal sided with the commissioner in Uganda and subjected the payments to withholding tax. Again, on the issue of reimbursement and disbursement, this is interesting because we've had our tax appeals tribunal here in Kenya struggle or in a way not be able to differentiate reimbursements and disbursements. But through this case, the Ugandan Tax Appeals Tribunal was able to clearly differentiate and say that VAT is payable on reimbursements and not on disbursements, which is the opposite of what happens in Kenya. For our last case, we talk about Ichiban Limited versus the Uganda Revenue Authority. This was a question on whether or not an ADR settlement that is reached between the taxpayer and the Uganda Revenue Authority can be adopted at the Tax Appeals Tribunal in Uganda, given that the same is not applied to the Tax Appeals Tribunal through the mediation process that is guided by the Ugandan Tax Appeals Tribunal. On this issue, the question was whether or not Ichiban Limited, having applied for ADR through one application and then applied for its matter to be heard at the Uganda Tax Appeals Tribunal through another application, could have asked the Tax Appeals Tribunal to adopt the ADR settlement. And the Uganda Tax Appeals Tribunal said for economic basis and for justice, it is only right that we adopt the ADR settlement. This is quite different again from Kenya, because in Kenya, we do not get to see ADR applications being applied outside of the premise of the Tax Appeals Tribunal. And with that, hand it over back to you, Robert. Thank you.
Thank you. Thank you very much, Christine, for that summary. And ladies and gentlemen, a lot of cases there, including the KCB case that said that VAT is payable by the person who is auctioning goods. And so the point there is just take care of the pleadings that you file at the Tax Appeals Tribunal, because this tribunal is looking at a lot of technicalities. Thank you very much, Christine, for that. Now, what is the outlook for 2025? The first thing is that with the budget policy statement having been approved by Cabinet, the budget has been approved at 4.2 trillion shillings. So we're now waiting for approval by Parliament, and we expect that to be in due course after the hearings. Thereafter, in line with the Public Finance Management Act, we expect to see the Finance Bill 2025 tabled, and this is one that we're waiting for with bated breath. Why? Because we don't have enough details from the budget policy statement, and we expect that to be published on or around 30th of April 2025, which will be a Wednesday. Once that is done, we expect that we'll have a public participation, proposals about what we want to see, what we don't want to see in that finance bill, and eventually to be culminated in a Finance Act of 2025. But before then, we expect the budget speech to be read or presented in Parliament on 12th of June 2025 by the CS National Treasury. That would be Honorable FCPA John Buddy's inaugural budget speech that will be presented on 12th of June 2025. And why 12th of June? Because traditionally in East Africa, the budget speeches are read on the last Thursday before 15th of June. So the last Thursday before 15th of June in 2025 will be 12th of June 2025. And so we'll be waiting to see what the CS will be proposing in terms of the tax measures. And with that, ladies and gentlemen, we now hand it back to Carol for the Q&A session. Carol.
Right. Thank you very much, Robert. Thank you very much, Christine. Very enlightening. So ladies and gentlemen, if you could put your questions into the chat, we will be taking as many of them as we can before our time is up. I am also putting into the chat a link for a survey. We would like to get to hear your thoughts on a number of matters around the tax environment. So please do go ahead and click on the link and be able to, be able to get the information from you. So I'll start us off with this, Robert. We went through the 3 phases of the NSSF. Are we expecting a 4th phase, or are we now done?
Absolutely. We're expecting a 4th and 5th phase. So the pain, I guess, continues.
All right. Any indication what does that mean for the taxpayer? What does that mean for employers?
Essentially, what that means is that any employed person will have to pay a little bit more in terms of an NSSF next year and probably the year after. And so we can expect a bit more pain. That's why I'm saying a bit more pain. The other thing is for employees, we expect for employers, we now expect that they'll also be funding a lot more. And so one of the things we've seen with some employers is saying, listen, our contribution to your pension is, say, 15,000 shillings. So all in will be 15,000 shillings, whether it's to NSSF or to your individual pension scheme, it will be 15%. So we expect to see a bit of that, shall we call it a reorganization in terms of pension contributions by employers.
Right, thank you. And a question here from Lucy asking around the PAYE, or rather not the PAYE, but the housing levy. Are directors' sitting allowances subject to the housing levy?
That's a good one. And the former Attorney General did issue an advisory opinion to Kenyatta National Hospital, because there was a big question as to whether affordable housing levy is payable by directors whenever they get their director's pay. Now, according to Revenue Authority as the implementing agency, yes, that is subject to affordable housing. But according to the advisory opinion by the Attorney General's office, the Attorney General was of the view that no, the directors are not subject to affordable housing levy. And the idea there is that directors are not employees. And so when a company pays the directors a sitting allowance, since these are not employees, then they do not qualify to pay or contribute to the affordable housing levy. So that is the current guidance that we have. And that is also sort of aligns with the High Court decision in a Nakuru case where it said directors are not employees. And so you really cannot subject them to tax as employees. But having said that, the Affordable Housing Levy Act is quite interesting, because it says if you are not captured as an employee, then any other income that you earn, including rental income, for example, or even interest income or dividend income, ideally that should be subject to a housing levy. So we expect that controversy to continue.
Right, thank you. And back to NSSF, there was a period when there had been a repeal, or rather a negation, and then we came back to the current. What happens to the employers who reverted to the 200 shilling deduction?
Yeah, that's a good question, and thanks for that question, Albert, because unfortunately in Kenya, the jurisprudence about there's a concept in India called the doctrine of subsisting precedents, which essentially means once you've been directed by a court and you comply with that direction or the finding of that court, then you cannot be held liable because any subsequent reversal or overturning of that position by the court will take effect from that day. But that doctrine is not well developed or even tested in Kenya. So to answer your question, I expect that in the event of a review by NSSF officers, they will go back to implementing the law from February 2023. Remember, February 2023 was the first period of implementing the new rates. So I expect that from February 2023 going forward, anybody who had not contributed would be subject to the penalties and probably the under payments that revenue that the National Social Security Fund would collect. So it's not very clear, but that's my view of the scenario, especially because the Court of Appeal ruling was in September 2022. And then there was a transition period where NSSF now was preparing and coming up with these lower tiers and upper tiers so that they can prepare to implement. And there was actually a notice to implement effective February 2023.
All right, thank you. And now taking us a little further afield to how Trumponomics is affecting us as Kenyans. This past Tuesday, now deemed Tariff Tuesday, we had the 10% tariff being declared essentially against several countries, Kenya included. Of course, this might not yet have come into law on this end, but what would that mean if that is actually effected?
Yeah, I mean, we're all waiting to see what's happening because these things keep on, like I saw yesterday, Trump saying that he expects this to significantly benefit the US, whereas some economists are saying, no, we can't see the benefit because the importers are the ones who are eventually going to pay this. But I think two critical points there, Carol. One is these are levies. They're not really taxes. Yes, they're distorting global commerce, but they are levies, and so the US could rightly say that they're protecting their markets, and therefore they're going to continue levying those or imposing those levies. However, from a Kenyan perspective, remember Kenya supplies to the US under the AGOA program, so which comes to an end in September 2025. So there's been a school of thought, and I've actually seen some commentary that because AGOA is enshrined under an act of Congress in the US, then this presidential action, which is an executive action, cannot override. And so Kenya should still be able to access. However, even today's Business Daily, the US Trade Representative is saying, no, we are imposing this because of what Kenya has also done, and particularly quoting the mitumbas that Kenya has imposed taxes at 35%. I didn't know actually we import a lot of mitumbas from the US. So you can see a hard stance there from the US. Likely scenario, our products will be expensive when exporting to the US. Of course, we're sitting much prettier than some countries like India and Vietnam, and some of these bigger countries that have been hit with significant taxes or levies. And so it's one that we're waiting to see, but one that clearly Trump looks determined to see through to the end.
Right, thank you. So we'll just two questions I think that we can take. So I'll just handle them at the same time. So one, back to the directors. So we have the confirmation around the housing levy. What about SHIF? How does SHIF affect director allowances? And you could also take this at the same time. This will probably be the first time we're going to be filing our returns post the E-Team's declarations. So how is this going to affect us? What can we expect? Are there any guidelines coming from Kerry?
Yeah, thanks for this question. So on SHIF, there's no guidance. Let's start from there. There's absolutely no guidance in terms of directors. However, it stands to reason that because the directors are not employees, then and since SHIF is for employees and actually requires employers to deduct and remit that amount to the authority, then my view would be that the directors are still not subject to SHIF. However, having said that, excuse me, to the extent that the directors have got income, then as individuals, under the shift regulations, even unemployed individuals are required to contribute. Now we know currently the 3.5 or so million people who are contributing are the employed people. So we don't really know how this is going to work out, but there's no guidance on that that particular question. In terms of the e-teams, you remember, and thanks for that question, because the law changed in 1st January 2024 to require that all expenses must be supported by e-teams. Now, of course, the implementation was a bit haphazard, and as at March, the rate of e-teams compliance was about 32% or so. So there's a big question. What do we do now that I don't have e-teams and the year 2024 is done? My view is that there's going to be some sort of concession by the commissioner. We are hoping that there's going to be some sort of concession, but 2025, commissioner will likely draw a line and say, you have to have your invoices supported. But again, of course, we have to ask, even though it's the law, will you take the revenue, but not consider that I have incurred expenses in generating that revenue? That is a big question. Carol?
All right, thank you very much. And thank you, ladies and gentlemen. Do remember, if you have any additional questions, you can reach any of us on the contacts on screen. You can also interact with us on our socials and are also on the screen. I have reposted the link. If you have not yet had an opportunity to click on it and start on our small survey, please do so. We look forward to seeing you next quarter. Remember, this is something that happens every single quarter. In the meantime, have yourselves an amazing day, and looking forward to seeing you in July. Thank you very much, ladies and gentlemen.